Okay, now we're going to take a look at some different money management examples, and as with all of these videos, we're going to develop these ideas in the webinars. These short videos are more of an introduction to the concepts. Remember, you've got to resist the urge to try and think that you can learn all of this in 5 minutes. This is new information for most of you, and if you try and learn too quickly, you will find yourself getting overwhelmed. I can guarantee you that. So remember, do these in small chunks. I'm trying to make these about half an hour a piece. And once you're done, then move on, do something completely different for 5 or 10 minutes, come back and watch the next one. If you just do these one after the other, bang, 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 you're going to find by the end of it you're confused, you're going to feel like this is way too complex and Mac is, just dumping a bunch of stuff on me. Take your time, learn this stuff slowly. We have plenty of time to get in on these moves that are happening in the marketplace. There's no reason to get in here and try and rush through it. So what are we looking at here? Basically, what I'm going to run through here is the idea of how and where do I move or do I put more money into the market. So we're going to talk about money management here, and we're going to talk about this whole concept of pyramiding, which, remember, pyramiding might be where you buy as the market is breaking out here, and then you can see, okay, the market makes a hand pattern here. So if the market breaks above that level, then I'm going to buy. So you can see right there, boom, makes a hand, breaks up above it. Oh, wow, there's another hand. So if it breaks above there, I'm going to enter in there too. Okay, so as the market starts moving up, you're buying as the market is proving to you that it has some strength. So let's talk about some of these numbers, and we'll talk about some of the risk that's associated with it. Okay, so in this example, I'm using a $3,000 account with 3% risk per position and 10% total risk. Okay, so what exactly does that mean? Well, let me get out my trusty calculator. 3,000 times 0.03 is equal to $90. So that means on each trade, I'm going to risk $90. The total risk is going to be $300. Okay, and again, this is very aggressive. Okay, because you could potentially lose 10% of your account. So let's take a look at this is a hypothetical example based on the move up in June. Okay, these were actual trades that went out. We're going to be using entries that are a little bit different, but these were trades which were on the daily videos that you and everyone else had access to. So let's talk about the kind of money that could have been made during that time with the $3,000 account. So this first entry I've got down here is at 97.67. Okay, that's when the market broke above here. The stop 97.32. Risk at 3%. That equals 2 mini lots. Now you see here I have something that's called 3-day ATR. Okay, ATR stands for average true range. Every trading application I know of will calculate this for you, and we'll go over ways to get that through Interbank. Stan Hoffman has done a fantastic job of making some of these tools available. I will be getting that code to you over time as well. So why is this significant? Well, what the average true range looks at is how big are the bars. How many times have you heard me say, if there's a big bar? So the question is, how big